Surendra, I want to come back to the headline point that you made on FPI selling and the fact that the positioning is at now multi-decadal low, not even multi-year low. Aside of the fact that obviously this is tactical positioning, right? I mean, whether it was the home market bias, whether it was some tactical quick shifts to China, which one understands. Aside of that, is there anything else that FPIs have sort of had an issue with in India? There's been some murmur on taxation, for instance. We also hear some murmurs about how registering in India is very time-consuming and difficult. But I don't know, maybe these murmurs also come through when a market is falling. In a rising market, you don't hear them. But what's your sense? Any other issues that are bothering FPIs?
Yeah, so I think I just add the point there that India's weightage in the EM indices has also gone up substantially. Okay, so say 5-6 years back, India's weightage used to be 8-9%, today it's 17% or so. So the weightage of India has gone up substantially, so that also kind of needs to be kept in mind. On the other points that you mentioned, again, I don't think a lot has changed in the last 3-4 months. Okay, so to that extent, I think as long as investors see the secular growth in India that they come for, I don't think those will play a big role, at least from a medium-term perspective, right? If you think about like Indian markets, any major index in the last 15 years or so, there has been like low double-digit, 11, 12, 13%, depending on which index you look at, that kind of earnings compounding. And that, I think, remains very important. If you see where the market pulled back and where FI flows happened, one of the things was the cyclical slowdown, right? But the fact is FY25 earnings have seen a moderation versus the start of the year expectation of Nifty delivering low double-digit growth will possibly end up with mid-single-digit growth. So to me, earnings moderation was one of the reasons, in addition to the stronger dollar and then later on China bouncing back. I think a lot of things came together, but the most important variable that I'm watching out for is earnings growth visibility. As that improves, I think that is what really gets people back into India.
I absolutely agree with you. At the end of the day, I mean, earnings speak for themselves, and at times they can speak the loudest in the room. Speaking of which, for FY25 is over, like you're saying, it's been a disappointing year, right? Maybe we'll get 6-7% at max. FY26, what's the growth that you're penciling in? And the larger question, do you believe this market can still keep compounding earnings at, say, 12 to 15% every year?
So, see, what we are expecting, what our team is expecting is a low to mid-teens kind of a growth next year, FY26. And again, the drivers, again, Samiran kind of spoke about the view on GDP. And we should see an improvement pretty much across quite a few sectors. So to that extent, that's what is really required. You need to see the visibility of earnings kind of getting to that number. We have been in an environment last few quarters where earnings have been revised down. So I think stability in the earnings outlook is the first thing we would watch out for. So that, I think, that number staying at low to mid-teens, I think that is what is really required for the market to find support and start going up from here. Medium term, I think low double-digit growth still possible in our view. Like if you look at nominal GDP growing at 10-11%, which is what the expectations are, then I think a growth which is somewhere in that territory. Of course, it could be volatile year to year, depending on how each of the sectors move. Particularly, commodities do add a fair bit of volatility and so on. But I think that kind of a medium-term compounding is possible. And that's what really makes India attractive from a EM and investors' perspective.
Samiran, finally, I want to ask you this because this is a new game in town, right? First, it was US exceptionalism and the numbers were supporting it. Then there was a lot of the talk of Chinese stimulus and then you had a tactical China trade. But Europe, like I said, is literally the new game in town. I mean, the amount of money that's pouring into European equities now. And we're seeing what's happening with German bond yields as well with this whole so-called rearmament exercise. Do you think this is meaningful from a near to medium term point of view, or is this just the market getting excited because we've not seen anything out of Europe in so long?
Yes, at this point of time, it's all about announcements. The next in line would be about trying to find the funding for this. At this moment, most of the funding is coming out of the national budgets rather than any specific fund at a European level for it. So we'll have to see which country has how much space in their budget to do these things. We are already seeing that countries which are closer to Russia are announcing a much larger defense plan compared to the rest of the countries. So that's the second part, which is the funding part. And then the third part would be the execution part on exactly how this money is going to be spent. If Europe just ends up buying or importing these armaments from somewhere else in the world, then it does not add up to the European GDP as much. But if this leads to more production within Europe, then the growth outlook becomes stronger. Our European economists, they think that the near-term growth impact for 2025 or 26 is relatively low, in the range of about 0.2 percentage point of GDP only. But if you move to 2027-28, then the impact could be more meaningful at 0.5 to 0.9% of GDP. In the context of Europe, which anyway grows only about 2% or so, this could be a very meaningful push-up in GDP growth if it actually happens.
That's very, very interesting. That's helpful perspective as well. I mean, really explains why the equity bulls are suddenly rushing and piling into European equities on that hope of that GDP boost coming through. But we hope, of course, that India continues its charting its own growth story as well. Gentlemen, thank you very much. It's been a pleasure having you on the show. Thank you for all the perspective.